Hello everybody and welcome back to another episode of Mind, Money, Soul. And I'm really excited about today's episode because I get asked this question all the freaking time and I'm going to answer it today. So should you be investing into the stock market or should you be investing in property? We live in a world where things are expensive, right? We can't have it all. And how do we choose between saving up and buying a property or getting on the stock market? So let's talk about it. First of all, let me just explain the difference between the two. Investing in the stock market is basically when you spend your money, your cash, investing it into buying shares into companies. This could be stocks, it could be funds. You can also invest in bonds. But you're essentially swapping your cash and putting it into publicly traded companies on the stock market, and you become a shareholder. You own a small piece of that business. Now, you make money from capital gains and dividends. Now, capital gains is when the value of that stock increases and then you sell it off at some point to make a profit. So when you still own the share, it's called unrealized capital gains, and when you then sell it off, it's called capital gains. But it also goes the other way with capital losses and unrealized capital losses when you make a loss. But you make money from capital gains, one, or you can make money from like passive income, which is through dividends, which basically is where that stock, that company or that fund pays you out some money. And it goes straight into your like account, whether you've got stocks and shares ISA, whether it's a SIP, whatever it is. But essentially they pay out to you. So that's option number one, investing in the stock market. Now, investing in property, you're essentially swapping your money for a property, usually by saving up cash for a deposit, and then you put a deposit down on the house, and then the rest of the money you get a loan. You take out a mortgage to make monthly payments to own more of the property each month until it's completely paid off. So the way in which you would make money from property in the long run is that obviously as you own this house, every single time that you pay the mortgage and you pay a little bit more to it, you have more equity in the house, which means you own more of it. So that capital, that money that you're paying off, goes towards you owning more of that asset. Now, you make money from a property by either the house property going up in value over the years, and then you sell it in the future for a profit, which essentially is also capital gains, or you make passive income by renting it out and someone else pays you to live there. So by having a tenant and somebody else is paying your mortgage, and you make money from that. So back 20, 30 years ago, property was a very, very, and probably one of the most viable options for people to build wealth, right? But now the stock market is becoming increasingly popular because like back 20, 30 years ago, it wasn't as easy to invest in the stock market. Now it is. So we're going to compare them by looking at the following things. Number one, understanding your financial goals and how long you have to invest. 2, accessibility to your money, so liquidity. 3 is the fees and the costs involved. 4 is the diversification of your investments. And then 5 is financial leverage. So let's go. Number one, understanding your financial goals and how long you have to invest. So before you pick between the two, you need to know, why are you wanting to invest? And like, what is it that you're actually working towards? So first of all, have a think about the type of lifestyle that you want. Because if you, for example, like me, want to be a digital nomad, or you want to travel around loads, or you think you're going to move, and you even think you're going to live in a different country, having a property in this country might be more of a hindrance than it is a help. So that's something to think about. Okay, so is your focus on like long-term growth and wealth building, or are you wanting like security and stability? Because your choice is going to depend on that. Now, it's going to look different for everybody, and there is no right or wrong. It's really important just to get honest with yourself and not lean into this idea of like, society knows what's best for me, my parents know what's best for me. No, you have to do what's right for you. Now, if you want to prioritize liquidity and growth, stocks or the stock market might be a better option for you. But if you want tangible assets and stability, property might be better. So yeah, first of all, think about what you actually want. Now, by the end of this episode, you might have a better idea of which one feels better for you. So let's go through the breakdown. So first off is accessibility to your money. So liquidity. Now, liquidity is essentially how quickly you can liquidate your assets, which basically means to sell off your assets and turn it back into cash. Now, property is not very easy to liquidate, right? It's a very long process. You have to go through solicitors, find a buyer, get the house sold, pay off the mortgage, get the cash. Like, it can be a really long process, and you can't just sell off parts of your property. You can't just sell off the bathroom or sell off the conservatory. The whole thing has to be sold off. So your money is basically in one asset that is not very easily sold off and liquidated. Now, with the stocks and the stock market, it's kind of the opposite, right? You can buy and sell stocks and funds all within a day quite easily. Now, whilst the same process is happening whereby, there's a buyer and you're selling it back and someone's buying it, it can all happen, especially digitally, very quickly. So the stock market is very easily liquidated. And this is why it's really important to know what you want for the future, because if you want to be able to access easily your cash or your asset, turn it into cash, then investing in the stock market through stocks and shares ISA is going to allow you to do that, because you have easy access to your money. So stocks and shares ISA is essentially an account that is tax efficient that you can use to invest in the stock market. Now, like I said, if you want access to your cash a lot easier, you'd have a stocks and shares ISA, you'd invest in the stock market, and you just buy and sell stocks and funds accordingly, liquidating it when you needed. You cannot do this with a property. Okay, so that is something to think about. Okay, now let's talk about the fees and the costs involved. Now, first of all, there's upfront costs. So like, how much does it cost to get involved? And then you also have all the sunken costs, all the money that you spend throughout the process and throughout having this asset that you don't really think about. Now, with the stock market, there really isn't a lot of upfront costs. The barriers to entry are a lot lower, and you literally can get started with like £5 a month, depending on who you go with. Something like, a trading app like Trading 212, literally you could start with like £1. Something like Vanguard, you need a little bit more upfront, but still, you're looking at maybe like £50, £100, £200 just to get started, which is nowhere near as much as what you need to get started with a property. Because with a property, when you save for a deposit, you usually need about 5 to 10% of the property price saved in cash. So if you were buying a house that was £500,000, you're going to need £25,000 to £50,000 saved in cash for deposit, right? Very different to the £200/£5 that you literally need to get started. And it's really important to think about how long it's going to take you to save up for that deposit. If it's going to take you 3, 4, 5 years, inflation is going to eat into that, and property prices are going to carry on rising. So that it might even look different by the time you actually come to buy a property. Okay, now even though a house or a property is a financial investment and you own an asset, it also comes with sunken costs, like maintenance costs. So taxes, the interest that you pay on your mortgage, obviously the upfront cost. Just to add to this, you've also got stamp duty, so that's an upfront cost. How much are you paying on stamp duty? How much are you paying your solicitor? How much are you paying your mortgage advisor? So that's some fixed costs. But then the sunken costs are, like I said, maintenance costs, things to keep the property running, the interest on your mortgage. And it's really important to run the numbers before you buy a property to make sure you understand what this is going to cost you. Now, Ramit Sethi, who's like a American kind of like financial educator, talks about this all the time. And he says people don't run the numbers properly to understand these sunken costs. Because what you want to do is you need to ensure that all of these extra costs that you are going to be forking out are covered by the appreciation of the value of the property. So when I say appreciation of the value, it just means the value of the property going up. You need to make sure that these sunken costs are covered by the appreciation. Because whilst the property may go up in value, which is great, if you spend an insane amount of money on all the things I just mentioned, on keeping it running, then the sunken costs are going to eat into the profit that you pay. So for example, let's just say like your house is worth £500,000, yeah? And you, the value of the property over 10 years goes up to like 600,000, you've basically made £100,000 in profit, right? But if over the course of those 10 years, it costs you £100,000 to keep the house running, you haven't made anything because that money's had to come from somewhere. So that's something really, really important to think about and to run the numbers on. The sunken costs of investing in the stock market is, if you don't own your home, obviously you are paying for renting, which means your money that you're paying for accommodation is going towards somebody else's mortgage, your landlord's mortgage. So that's essentially a sunken cost, right? Because your money is going towards someone else. However, renting does give you a lot of flexibility, and it means you don't have to pay all the other costs for your property. But apart from that, I wouldn't really say there's many other sunken costs except the fees of like the platform or the fees that it costs to trade, so to buy and sell. So when you're opening up an account and you're picking a platform, you want to check the fees. But low cost platforms, you might pay anywhere between like 0.1% to 0.5% maybe. You might also pay a flat fee to have a subscription with a platform, but they are nowhere near as much as it costs to have property. So the sunken fees and the upfront fees for the stock market are a lot lower. Okay, and then we want to think about diversification. So it's a lot harder to diversify your money with property unless you have a lot of money, right? So you can buy loads of properties, totally, and then you diversify your money. But if you own one house and that's your one investment, all of your eggs are in one basket. And with investing, you don't want to have all of your eggs in one basket, because if one thing happens to that asset, you end up in a bit of a sticky situation, right? Now, the great thing with the stock market is that you can pool your risk across a range of different investments. So it's really easy to diversify in the stock market because you can own multiple stocks, or if you invest into index funds and ETFs, your money is automatically diversified. So essentially you are spreading your risk. So if one of those assets or one of those stocks or one of those companies goes bust, your money is diversified and spread out across a bunch of other investments. So it's really important to think about diversification as well. And then the other thing that I'm going to touch on is leverage. Now, with a property, you can borrow money that you don't have to make the investment. So essentially you take out a loan against the property, which is your mortgage. It has interest charged by the bank or by the loan provider, but by borrowing this money up front, you can build your wealth through leveraging that debt. So this is a good kind of debt, right? You're essentially being given money up front that you don't have to buy an asset, but the aim is that that asset goes up in price over time. So you are leveraging capital and taking out debt so that you can build your wealth for the long term. So you can do that with property, but you cannot do this with stocks. You cannot, borrow money from the bank to invest it all in the stock market to make more money. Now, whilst you technically could take a loan out, and then you could take that money out in cash, that loan is going to have interest. So is it going to make sense to do that in the stock market? Probably not. This is something to think about when it comes to the money that you need. Money for the stock market, to invest in the stock market, is going to need to come from your pocket. It's going to need to come from the money that you make with your job or with your side hustles. Okay, so let's just kind of break down pros and cons of both. Stock market, pros and cons. Pros, it is easily liquidated, so you have easy access to your money. It's very easy to get started quickly. You can literally get started now, and it means that you can make the most of compound interest. The cons are that you don't own anything tangible, perhaps could be more volatile than the stock The stock market could be more volatile than property. And also you could still be renting, which means you feel like you're wasting money paying off rent to go towards somebody else's mortgage. Now, with the property, pros, you have something tangible that you own. You own a building that you literally get to live in and do what you want with. It gives you security. It gives you a sense of stability, especially within your home, because your landlord can't kick you out because you are your own landlord. And also, the mortgage is like a built-in savings plan, because every month that you are paying the mortgage, you are building equity into an asset. So it's like a built-in savings plan. And you might also have an emotional attachment to having a property, of always wanting your own home. Now, the cons is that it can be hard to get hold of the money that you need without selling the property, so it's not very easily liquidated. You can remortgage and take equity out of your property, but that's a whole nother family. It costs a lot of money to get started. There are a lot of fees to get on the property market. There are so many issues with the property getting started and getting on the property ladder, which is something that financial experts talk about all the time. And also the additional fees and the sunken fees, you have to have that money in cash to pay for them. So yeah, that's the pros and the cons. And this is why it's so important to understand what you actually want from your life and what you therefore want from investing. Now, a potential idea is that you could save money, invest money in the stock market, and then in 5-10 years time, the money that you've made from the stock market, pull out to put into a property, and then you kind of got both. However, the risk there involved is that your capital is always at risk when you are investing, right? So there isn't a guarantee of that. So that's just something to take into consideration. And in addition to this, some things make more emotional sense than they do financial sense. For example, if you've always wanted to have your own home and you've just wanted to be able to like call something your own, even if it makes you less profit and it costs you more, if this is your dream and it works for you, not everything is about financial gain in this life, right? Because money doesn't make us happier. It's what we do with our money. So if you've run the numbers, and you know what you're getting into and you know what you're working with, but you're like, for me, I still want to buy my own home, you go Glen Coco, you do that for you. Just the same as if you're like, my dream is to be able to like live in different places, travel around. I've run the numbers and it would make sense for me to invest in property financially, but emotionally, I don't want to be tied to a physical property or a physical asset. Then the stock market's going to make more sense, even though financially the other one might make you a bit more. So these are the things that is really important to think about. Now, something I didn't touch on was this idea around like the money that you make back. So like yield, which offers a greater return. The reason why I didn't dive into this is because it's so hard to say, because it really depends where you buy your property, what type of property you buy, what you're doing with that property, when you're selling that property, what the property market looks like in 5-10 years. The same as the stock market. It depends what you invest in. It depends whether you invest in individual stocks or whether you invest in index funds, how long you're invested for. There's so many factors that you cannot say which one or the other is going to give you more financial gain. Now, I did a panel recently with a friend of mine who basically was like, you make more money from property. However, he bought his property back in like 2009. He stayed in it. The barriers to entry were a lot lower. He had a government scheme that allowed him to like save a bit of money on the property. So there were all these things financially that helped him. But nowadays, for me, it made more sense for me to get invested in the stock market. But luckily, we live in a world where we can start investing now very easily with access to the stock market. So I think just think about some of these things, think about what's important to you, and if just ask yourself like which one makes more emotional sense, which one makes more financial sense, but also know that once you've made a decision, you can change your mind. Doesn't mean it's going to be easy, right? If you get on the property ladder and then you end up like wanting to change your mind, it's going to be harder to sell, especially if it's like not a seller's market. I'm a big fan of investing in the stock market personally because of how easily accessible it is and how you can just start building your wealth and like retaining the buying power of your money straight away. I plan to buy a property in the future at some point, maybe 10 years. Maybe I'll use some of the money from my investments. Who knows? But I will figure it out then. The property prices are going to carry on buying, and your argument might be like, well, is it not better to get on the property ladder now? Maybe, but only if all the other things make sense to you. So yeah, I hope this helps. I hope it's given you some food for thought. Feel free to like slide into my DM and ask me any questions about it. And I will see you all next week. Mwah.